Welcome back to another video on the YouTube channel. In today's video, we will find out 5 mistakes to avoid as first-time homekeeper. For most people, buying a home is often the biggest investment of their life. Between the joy of buying a property and the stress of its financial implications, a first-time buyer becomes prone to errors. You may feel the pressure to find a home right away, but before you visit homes and start bidding, your financing in order. But we are here to tell you how to avoid these following mistakes. Number 5. Over-borrowing money to buy an unaffordable property. In their over-enthusiasm, first-time homebuyers often make the mistake of opting for homes that are beyond their monetary capacity. They tend to borrow excessively and later on regret their decision. Since your home will not be the only responsibility in the future, putting too much effort into it would not only be stressful financially, but mentally as well. Home investments are long-term loyalties, and any effect attached to it would be felt for a long time. The first and most obvious decision point has to do with money. If you have the means to buy a house for cash, go for it. Well, you can pay in cash. Most experts will agree that you can afford the purchase if you qualify for a mortgage on a new home. But how much mortgage can you afford? The Federal Housing Administration generally uses the 43% debt-to-income ratio standard as a guide for mortgage approval. This report is used to determine if the borrower can make payments each month. Some lenders may be more lenient or strict, depending on the housing market and general economic conditions. A DTI of 43% means all regular payments of your debt, plus expenses related to housing, mortgage insurance, homeowners membership dues, property taxes, landlord's insurance of houses, etc., should not be more than 43% of your gross monthly income. Number 4. Skipping the home inspection. Unless you have a lot of money to fix a home and are willing to risk to pay for unexpected repairs, foregoing a home inspection can be a costly mistake. Home inspections are meant to find major problems with the home and are meant to protect the buyer. If you don't receive an inspection, you will have no recourse if a serious problem, such as broken pipes or water damage, comes to the surface after you lock yourself in a house. This means that you could pay the entire bill to fix these problems. When bidding on a home, you can include home inspection contingency that gets you a penalty-free exit from the contract if a major problem is found out and the seller is unwilling to rectify it before closing. With that contingency in place, you can withdraw your offer and usually get a full refund of your security deposit. The home inspection fee is non-refundable and is generally paid by the buyer to the home inspector in advance. It typically ranges from $300 to $500 depending on the location and size of property. It's a small price to pay when you compare it to the potential costs to replace an oven, water heater, roof, or another expensive item which could run into thousands. You may have to consider further inspections such as pest inspection, a mold or radon inspection, or a sewer area if your lender requests it. These and other inspections can help ensure your investment and security. Number 3. Not shopping around for a mortgage. Homebuyers can leave a lot of money on the table when they're not looking for a mortgage. Taking out a mortgage with a few different lenders gives you a better idea of what you can afford and allows you to make an accurate comparison of the lender's loan products, interest rates, closing costs, and fees. More importantly, looking for a mortgage puts you in a better position to negotiate the best possible deal with lenders. When looking for lenders, pay close attention to the fees and closing costs, which can add up to the closing table. While some of the price swings may not seem big on paper now, they can add significant cost savings over the life of the loan. Keep in mind that some lenders will offer you discount points, a way to lower your interest rate early. This increases the closing costs for different lenders who facilitate low or no closing costs and tends to charge higher interest rates to make up for the difference. Home buyers in the United States pay on average $5,749 for closing costs, according to a 2019 survey by Closing Corp, a real estate closing cost data company. In addition to checking with your current financial institution, whether it's a bank or credit union, ask a mortgage broker to compare rates on your behalf. Mortgage brokers are not lenders. They act as mediators between you and the lenders of your network. They can save your time and money by comparing various lenders that have products that suit your needs. Also, it's worth looking at some direct lenders online or in person to see what they have in offer. Number 2. Not hiring a real estate agent. Trying to find a home on your own is long and complicated. An experienced and professional real estate agent can help you narrow down your options and spot problems with physical ownership and in the process of negotiating with sellers. Some states require a real estate advisor to handle the transaction, but the advisors won't help you look for a home. They can help you write an offer, negotiate the purchase agreement, and act as a closing agent though. Also, if you go to screenings without your real estate agent, a seller's agent might offer to represent you. This can be dangerous because that agent doesn't have your best interest in mind. Your goal must be to get the best and highest offer for the seller. Having your agent whose interests are more aligned with yours will help you make more informed decisions. In a competitive marketplace, sellers won't take you seriously without a pre-approval letter, and you may lose the home you really want. This document lists the loan amount you're eligible for, the interest rate, loan schedule, and the estimated down payment amount. In some cases, especially for more expensive homes or in super competitive markets, lenders may ask you to provide proof of funds for a down payment. The pre-approval letter also includes an expiration date, usually within 90 days. Best of all, the cost of hiring an agent won't go out of your pocket. As a buyer, you generally don't pay the buyer's agent fee. It is usually paid by the seller to the seller's agent, who then splits the commission with the buyer's agent. Number 1. Not keeping tabs on your credit. Nobody likes surprises, especially before buying a house. If you or your spouse have obvious credit problems like a history of late payments, debt collection actions, or significant debt, mortgage lenders may provide you with ideal interest rates and terms or deny your application outright. Both situations can be frustrating and delay your ideal timeline. To address potential issues early, check with your credit report for free annually at annualcreditreport.com from each of the 3 credit reporting agencies: TransUnion, Equifax, and Experian. Look for errors and discuss different errors in writing with the reporting agency and creditor, including supporting documentation to present your case. For more proactive help, consider using one of the best credit monitoring services. If you find current but precise negative elements such as late payments or unpaid accounts, there is no way to quickly remove those elements. Unfortunately, they are going to remain on your credit report for 7 to 10 years. But you can increase your score by paying your bills on time, paying more than the monthly minimum of debt, and not maximizing your available credit. Above all, be patient. It can take at least a year to improve a low credit rating. Also, check if your bank, credit union, or credit card provider gives you free access to your credit score. If your score is below 620, you'll have trouble getting approved for a standard mortgage. To qualify for an FHA loan, you will need a minimum credit score of 580 to use the program's maximum funding, or a minimum score of 500 with a 110% down payment required by the FHA. Credit requirements for FHA loans. That's it for today's video. Till then, stay healthy, stay safe, stay happy, see ya.